It may come as a surprise to you, but nearly 25% of all Americans owe more on their home than what the home is actually worth. Now, if you find yourself in that unfortunate situation, then the question becomes is what do you do about that upside down mortgage? So your options are you going to let it go into foreclosure? Are you going to try to sell it via a short sale? Or are you actually going to try to do a loan modification? What we're going to propose is that you consider something that you've probably never heard of, and that is doing principal reduction with a refinance. Now, let's suppose this is your situation. Let's say you owe more on your home or investment property than the property is actually worth. Then our mortgage group would like to have a chance to refinance you at a lower balance and payment. I know this probably is going to sound a bit strange to you, but if you'll give us just a few moments and let us explain of how this really works. So let's just do an example of how this might work. Suppose that there is a home and there is a $300,000 mortgage on it, whether that's a single mortgage or first and second mortgage combined. And let's say that home is only worth $185,000 today. That means that the homeowner is upside down, in this case, by $115,000. Suppose that we could offer you a refinance on that property that was at 95% of today's current value, i.e., as there would be a new loan written, and that loan amount would be $175,750. So instead of being $115,000 upside down, it would turn out that you would actually have some positive equity of $9,250. In addition is what you'll find is because that equity has been dropped a good bit, then you'll actually have significantly less monthly payments as well. So in this particular example, this homeowner would have saved $124,000 and change on equity, and in addition, they would be paying a little over $1,000 a month less than what they were currently paying. What is principal reduction? Principal reduction plan is just simply someone buys your current loan and then restructures it, but they restructure it in a way that it now works for you, and in addition, it works for them. In the financial industry, financial institutions buy and sell loans all the time. If a financial group like us buys your loan, then they can offer to replace your loan if you agree. And of course, if the loan that we offer to replace it with is substantially better than what you currently have, then of course you would agree to that. We want to explain this is absolutely not a loan modification. In a principal reduction plan is your existing mortgage is purchased and there is a brand new mortgage holder that alters your payments and principal. Under a loan modification, then either yourself or somebody else negotiates with your current lender. And frequently, only the payment terms are altered, not the principal or the balance. And under a loan modification, there is not a new mortgage holder. So these principal reduction and loan modification really have nothing to do with one another. As far as the program, what we're willing to accept in the way of properties, we're willing to accept single-family homes, we're willing to accept townhomes, condos. In addition, if those are investment properties, those fall under this program as well. And even if they are vacation homes. Now currently we're not accepting raw land, so if you've bought a lot or something like that, and in addition is currently we're not working with commercial properties. Now the terms of that refinance. So the new balance of that loan, of the new loan that would be written, would need 95% of current value. So again, this has nothing to do with the amount that you currently have financed. In addition, depending on your credit scores, the interest rate would either be prime plus 3% or prime plus 4%, depending on your current credit scores. Now, one of the questions that we commonly get is my property is so upside down. I owe so much more than it's actually worth. So let's say we take another example where you have a first and a second mortgage, and all totaled up, the person owes $450,000. Well, it turns out that the more upside down this property is, the better. We're going to show you a form in just a minute, but when you complete that form, we want to make sure that you include all the loans on the property. So whether it's a first mortgage, a second mortgage, a home equity line of credit, all those kinds of things. How much does this cost? How much does it cost to get involved? Okay. At the time when you complete the form, which basically plugs you into the pre-approval process, that costs you absolutely nothing. Then, just like any other loan that's out there, you're going to be asked for a series of paperwork and documentation and all kinds of things. And there are no fees involved at that point either. There is no fees charged until the loan actually is ready to close. So you're ready to get a new loan at a significantly reduced balance and significantly reduced payments. We absolutely want to stress is that there is nothing owed unless the refinance is provided. And this is like any other type of refinance that you've probably ever done before. From the page that sent you to this video, you will see either a link or you'll see this form where all you got to do is fill out your information and press submit, and that automatically drops you into the pre-approval process, and then from there somebody will be in contact with you shortly.